When people are making a decision on, whether to lock themselves into a 30-year mortgage, they're thinking about the future. Whether or not to get that 3-year loan on a car, they're not thinking about what they made in the last year. They're thinking about, am I going to have a job in 3 years, and am I going to be able to pay off this car?
Fed Chairman Jerome Powell was asked several FOMC meetings ago by a reporter whether or not the Fed looks at soft data in conjunction with hard data to make evaluations for monetary policy. Would this qualify as a coincident indicator soft data point that the Fed could use? The University of Michigan Consumer Sentiment Survey is one of the most followed economic indicators on mainstream. And we're going to be talking about the outlook for consumer sentiment with one of the people responsible for putting this together. She is Joanne Hsu, former reserve economist from 2011 to 2022 and current director of the surveys of consumers at the University of Michigan, where she is currently tenured as a research associate professor. Dr. Hsu's research bridges consumer psychology and macro policy. Welcome to the show. Pleasure to host you. Honored to speaking with you today. Let's start by talking about the recent data. July 2025 preliminary data shows sentiment slightly around 61.8, the highest in 5 months, still below the historical average, though. Can you describe in basic terms for the layman how Americans are feeling right now about the economy?
Overall, consumers are feeling relatively downbeat about the outlook for the economy, and that's been the case since the very beginning of the year. Even though there was a post-election bump in sentiment over the course of 2025, sentiment had been on a several-month consecutive decline, very much being driven by consumer fears about tariff policy. As trade policy development started to quiet down a bit in May and June, and also in the beginning of July, consumers started to feel a little bit more stable about the economy, that maybe their worst fears weren't coming to pass. And that explains the jump in sentiment that we saw in June, as well as the small tick up that we saw in July. But at the same time, we're still well below where we were 6 months ago, a year ago. And consumers are still quite concerned that inflation might come roaring back.
What transfer factors usually influence the changing tides of consumer sentiment, according to your research?
The decades of research that we've done with the surveys of consumers have shown that consumers are really incorporating a lot of information around them. It could be the prices that they're facing around them, their impressions of labor markets, their assessment of policy, stock markets for those who are stock market participants. And so different households are going to be shaped by different factors around them. And what the survey has shown is that over this decades of research, the national average actually does a pretty good job at identifying risks in the economy. What's really unique about the current moment, though, is that across the demographic spectrum, the income distribution, and even the political spectrum, broadly, Americans are in agreement that one of the big risks right now is coming from trade policy. This is stemming from the fact that from the past several years, consumers have been all quite worried about inflation. Inflation, cost of living, that has been one of the top factors on consumers' minds since the end of the pandemic. And one of the big threats they see to that right now is the volatility of trade policy, as well as the high level of threatened tariffs.
Okay, let's just take a look here at the overall sentiment index. So like we discussed, it is higher than where it was previously a couple of prints ago, but still lower than the historical average. Here's a featured chart from the website. Despite recent uptick, sentiment for the high wealth consumer down 17% since December 2024. This is an interesting divergence because typically in the past, I've noticed at least, that sentiment for the ultra wealthy are tied to asset price performance. And as you know, asset prices, particularly with the stock markets and with risk assets like Bitcoin, have been at all-time highs. Why is sentiment with the ultra wealthy also not at all-time highs?
Again, this is one of the things where people across the wealth spectrum are in agreement that they are really worried about the risk that's coming from tariff policy. Going back to this gradient between high and low wealth consumers, as you can see in this chart, historically speaking, higher wealth consumers have more favorable sentiment than lower wealth consumers. But when you look in the period approaching mid-2022, that peak of inflation, that sentiment converged very much because of the shared views that inflation was a major threat to the economy. As inflation started to slow, we see high levels of sentiment or we see a huge climb, a steep climb in sentiment for the highest wealth consumers, being driven by the fact that they understand that inflation is slowing. They're being supported by high asset values. And that's consistent with the strong consumer spending that we saw during this period. But with this onset of highly volatile trade policy, in spite of the fact that stock markets have very much shrugged off the risks from trade policy, those consumers, those high wealth consumers, still believe it's a risk, and that explains the convergence in sentiment that we saw over the last few months. But notice that this uptick that we see in sentiment among the wealthy over June and July, we only see that among the wealthy. We're not actually seeing that among non-stock participants, which is, another piece of evidence that wealthy consumers are being buoyed by strong financial market performance.
Flipping back to the sentiment of consumer index here, have you noticed any correlation between this index and actual economic growth? In other words, does it serve as a leading indicator or a coincident indicator for GDP?
We've been measuring consumer sentiment, we being the University of Michigan, since before I was born. So we have a very long time series to look at. And historically speaking, when consumer sentiment is on exhibits a strong decline, an economic downturn typically follows. And that's what we've seen over decades and decades. One notable exception is 2022, where you see the steep decline in consumer sentiment concurrent with the peaking of inflation, which was not followed by a recession. But one should note that a lot of leading indicators broke down during that period, including inverted yield curve, the SOM rule, many other traditionally strong economic relationships didn't really hold during that period. And also there were a lot of analysts and commentators forecasting a recession at that time. So it was hardly just consumers that didn't quite get it right. But I do want to note that the current moment is very different than 2022. In 22, despite weak sentiment, consumer spending remained strong, I think, for two different reasons. One is that labor markets were incredibly tight and strong at that time. People had reliable incomes. Anyone who wanted a job could very much could find one. And on top of that, higher wealth, higher income consumers, their sentiment recovered quite quickly, though it's a little bit harder to see on the average. So we had a lot of strength that was driving strong consumer spending at that time. Currently, however, consumer views of labor market expectations are actually quite weak. We have 2/3 of consumers who are telling us that they believe unemployment rates are going to rise in the year ahead. And moreover, they expect to be personally affected. When we ask people, what's the probability that you'll lose your own job in the next few years, that's at elevated levels. When we ask about their income expectations, that's weaker than usual and has been weak for some time. So it seems that the strong incomes that supported consumer spending post-pandemic, those expectations might not really be there to support consumer spending in the year ahead.
I guess for economists who follow the consumer sentiment indicator index, many of them are interested in knowing whether or not this has predictive power in actual consumer spending in the following quarter. Can you comment on that?
Sure. So one of the big things that happened right after the election was a surge in consumers saying now is a good time to buy big ticket items, specifically because they felt that if you buy things now, that will allow you to avoid tariff hikes in the future. And indeed, 2024 Q4, we saw very robust auto sales as well as durable sales. And then this severe decline in consumer sentiment that began in January. Indeed, we saw a pullback and a slowdown in consumer spending in Q1 as well. We're starting to see some signs of strength with consumer spending in recent months, and that's also consistent with this uptick in sentiment that we're seeing right now. So we see it in the macro, but we also see it in the micro. There are many people who are quite surprised at partisan differences in consumer sentiment that we measure. It's generally the case, going back to the Reagan administration, that consumers who belong to the same party as the president tend to have higher levels of sentiment and vice versa. And we see that in terms of consumer behavior as well. Academic research has shown that the exact same partisan differences in consumer spending, in small business formation, in patent application behavior, and even in tax evasion, where people behave in one way when they belong to the same party in power, and around a presidential transition, those relationships switch. So even though it might seem odd to people to see this partisan difference, in fact, there's a wealth of research that shows these micro-level differences in sentiment being correlated with the same type of micro-level variation in behavior.
What has been interesting to me in the past, Dr. Hsu, is observing differences or divergences between sentiment of the upper tercile of income of people surveyed and the bottom tercile. First of all, so two-part question. First of all, are you noticing any such divergence now? And when it does happen, does it usually mean anything?
So typically speaking, the higher income you are, you tend to have more favorable levels of sentiment. And convergences tend to happen when sentiment is on the decline. So when sentiment declined during right before the pandemic recession, right before the post-pandemic peak of inflation in mid-2022, and this year there's a convergence. There begins to be a convergence in sentiment. And then the key really is after that convergence, and once a local trough is reached, do higher income consumers remain there? Looking at the higher income consumer sentiment is very important because higher income consumers, they generate the lion's share of consumer spending, right? So for aggregate consumer spending to be robust, you really need those higher income families being out there and willing to spend. Right now, we're basically all income groups are in agreement that the outlook for the economy has soured since the beginning of the year. Again, this is because of massive concern, major concerns over trade policy. And trade policy still remains really uncertain right now. So at this time, while higher income consumers, they are supported by higher levels of savings, as well as a wealth effect coming from strong financial markets, as well as high housing prices. Even they are not feeling comfortable or confident about their future incomes. So that is something that I think is very important to watch. It's really hard to have continued robust aggregate spending without that upper end of the income distribution being willing to go out there and spend.
We're seeing signs that the labor market is currently under some stress, in the sense that people who are out of the labor market are finding it difficult to find a job. Hirings are coming down from a year ago, and even people in the labor market currently are reporting lower instances of getting a raise. And so my question is, if sentiment remains, anchored on trade policy, and trade policy, like you said, remains uncertain, can we make the assumption that hiring will continue to be somewhat fragmented, if not weak, going into 2026?
That's certainly what consumers are expecting. And that's why I'm cautioning people who are watching the economy. It's hard to imagine how consumer spending can remain as robust as it's been in the past few years when people are observing these signs of weaknesses in the labor markets. And when we ask them about their labor market expectations, they are expressing loud and clear they are very worried about the trajectory of the labor market. So in that sense, if you don't feel confident about your incomes, you're already feeling like the economy might be headed for a slowdown because of this volatility in trade policy, you're not going to be willing to go out there and take financial risks, that whether that's buying a house or making an investment, making a major investment, or spending at the limit of your budget. And in that sense, that's of course going to have follow-on effects on employers and producers who may not be able to hire and keep the labor market as strong as it's been in the few years following the pandemic.
Does your survey give any indications for small business optimism at all?
We don't ask specifically about small business optimism, but of course, there is a small business index based on business owners, and we've been seeing pretty similar things where with these worries about about trade policy, about tariffs. The reason why we know that tariffs are so high on people's minds is that on our survey, we have several opportunities for consumers to offer any comments that they want. It's a completely open-ended set of questions. And over the last few months, we've had 60% to 2/3 of consumers spontaneously offering unsolicited comments about tariffs. It's hard in normal times or in typical times to get half of people agreeing on anything. So it's been really striking from a researcher's point of view just how much agreement there is about this concern over tariff policy. And this is very much in contrast to other aspects of fiscal policy or government policy. We have maybe less than 5% of consumers mentioning the tax and spending bill, a handful of consumers every month mentioning something about DOGE or immigration. And by and large, in those situations, it's a balance between people who think a particular policy is good for the economy and a particular policy is bad for the economy. But when it comes to tariffs, everyone's in agreement. Even those who might think high tariffs are better for the economy in the long run, everyone seems to believe that it's going to lead to short-term pain and particularly a return of inflation.
Is that what you believe as well?
I mean, I think it's very clear that when tariff policy, when any sort of policy has a high level of uncertainty, it's very difficult for businesses to plan. And likewise, it's really difficult for consumers to plan. So I think it's really prudent, both for consumers as well as producers, to hold off on major changes, major investments, or major decisions until policy has firmed up. And so, of course, different people might disagree about where the right level of tariffs is for a particular type of good or a particular type of import. But I think we can all agree that uncertainty makes things very complicated and difficult for people to make long-run decisions and investments.
So besides more clarity and stability in trade policy, what else could potentially improve consumer sentiment?
Consumers have been bracing for impact on inflation for the last few months. And as soon as those reciprocal tariffs were announced in the beginning of April, consumers by and large were expecting a worst case scenario. So the fact that a worst case scenario has not come to fruition at this time certainly bodes well for consumer sentiment. And indeed, between May, June, and July, we did see some improvement when those worst case scenarios haven't come to pass. If it turns out that tariff costs are largely eaten by other parties and not the consumer, then consumer sentiment is likely to continue lifting. But that is, of course, is still going to be predicated on labor markets continuing to be strong. If producers end up eating these tariffs and at the same time start laying people off, then on net, the consumer is still going to be feeling pretty negative about the economy.
I want to just get into their methodology first, but before that, maybe just explain to the layman watching this how to actually read this chart. So we know that the direction indicates improving or deterioration, but the index level is, it's 100 at 1966, which is about 50 years ago. Currently, we're at just over, between 55 to 65, which, just looking at this, one could interpret it's 45% lower than the 1966 level. Practically speaking, what does that mean?
So we index all our values to 1966. And the thing to note is that 1966, the economy was quite strong. So we shouldn't think of 100 as neutral. 100 is actually quite strong. In contrast, our all-time low of 50 was reached in June of 2022. So 50 is the all-time historic low point over the last 75 or so years. So the 60 something that we're at right now is, it's better than 50, but it's still pretty negative. I think more important than the level, because, as you said, 1966 was 50 plus years ago. And, society has changed a lot over time. I think more important is to note the trend. And so notably, you'll see leading into the pandemic, consumer sentiment was relatively flat. It would go up, it would go down, but it was kind of moving in a fairly narrow range. And in contrast, the first few months of 2025, we really saw a plunge. And this multi-month consecutive decline that we saw over the course of this year is historically quite unusual. And so there's been an uptick in June and July. We'll see if this sticks when our final data come out next Friday. But we're still well below the historical average. And overall, consumers do not believe we are out of the woods.
Can you walk us through your sampling process for obtaining the survey?
Absolutely. We are a nationally representative survey of the 48 states plus DC and of all adults 18 and older. So it's not concentrated on Michigan. It's not concentrated on university students. There are actually very few university students in the sample because we're hitting all households. We take a random sample of all postal addresses in the coterminous 48 and DC. And in these invitations, there's a URL and a QR code for you to fill out the survey. So by doing an address-based sampling, this ensures we know exactly where we're getting responses from and where we're not getting responses from. And so we can ensure that we are maintaining a nationally representative sample. And so, I want to extend my thanks to any of your viewers who might have completed a survey in the past. And if you do receive an invitation, please do fill it out. But there is a 1-800 number on there if you have any questions about.
Please do participate. If you're watching, it's very helpful for all observants of the economy, professional economists and or otherwise. I'm just wondering here, this is just a complete hypothesis, but is it possible, Dr. Hsu, that if, let's say, you're really not doing well as a household and you're feeling despondent, you're not going to complete the survey or any surveys for that matter because you just aren't in the mood to. And so therefore, it's probably overestimating sentiment than the current actual condition. Is that possible?
It is possible, but you can also imagine the other situation where you feel like you're having a tough time in the economy and no one's listening, and now you have an opportunity to express yourself. So that could be happening as well. So I think that probably both are happening at the same time. I do know that in the Great Recession, as you mentioned, I used to work at the Federal Reserve, where I worked on the survey of consumer finances, and they did a Great Recession 2009 follow-up to a 2007 survey. And there were a lot of concerns that people who weren't expecting to be contacted again for a re-interview would be unwilling to do it. But 2009, people were deeply suffering during the financial crisis and wanted to talk to somebody about it and make sure that policymakers heard their voices. And so, in fact, it actually turned out to be a very successful data collection. And I think that's similar to something that the surveys of consumers at the University of Michigan also experienced in the beginning of the pandemic, when a lot of data collections were put on hold or were having a lot of trouble because of the shutdown of the economy. But my team was able to pivot very quickly, and people did want to share with us their experiences during the pandemic. So, we are very fortunate for the generosity of our respondents in sharing their views of the economy.
Fed Chairman Jerome Powell was asked several FOMC meetings ago by a reporter whether or not the Fed looks at soft data in conjunction with hard data to make evaluations for monetary policy. Would this qualify as a coincident indicator soft data point that the Fed could use? The consumer survey?
So when people talk about hard data, they're typically talking about backwards looking data, right? CPI from a year ago relative to a year ago, last month's unemployment rate. Whereas consumer sentiment is specifically forward looking. We are asking consumers to project out what they think is going to happen in the next year and the next 5 years. And while it might seem like we're asking consumers to look into a crystal ball, in fact, research has shown that these are exactly the factors consumers are taking into account when they're making major economic decisions. When people are making a decision on, whether to lock themselves into a 30-year mortgage, they're thinking about the future. Whether or not to get that 3-year loan on a car, they're not thinking about what they made in the last year. They're thinking about, am I going to have a job in 3 years, and am I going to be able to pay off this car? I would say backward-looking data, forward-looking data, all of these things are going to be important to policymakers. And if you look at the historical teal books that are put and transcripts that are put on the FOMC website, you'll see that the University of Michigan is charted and mentioned every time.
Looking back, what were some of the pivotal moments throughout the history of the University of Michigan Consumer Sentiment Index that has propelled it to become a mainstream indicator that is forward-looking, that is used by policymakers, that is used by economists alike? How did it start, and how did it become what it is now?
The surveys of consumers were founded by George Katona back in 1946, and back then, behavioral economics was not even a thing. And so George Katona was really groundbreaking in trying to bring together psychology and economics to understand consumer behavior. And what he did at that time was, again, absolutely groundbreaking. And surveys had not really even been invented then. So it was a really special time at the University of Michigan here at the Institute for Social Research, where essentially the survey was born. And so the surveys of consumers, as well as the field of survey methodology, has really evolved and strengthened over time right here in Ann Arbor. But in terms of the survey's utility and predictive ability as a leading indicator, that's been proven over many decades of work. There's been academic research that shows that consumer sentiment has additional predictive power for consumer spending above and beyond traditional indicators and lagged indicators thereof. There is some additional information and signal that's coming from that. And in addition, the surveys of consumers isn't just measuring, one measure of sentiment plus one or two measures of inflation expectations. We're asking consumers about all sorts of aspects of the economy, including labor markets, stock markets, housing markets, big ticket buying of big ticket items and vehicles, among many others. And so, people who are watching the data closely will also dig into the data to the parts of the economy that matter most to them. And so taken together, I think that we've really proven that we're collecting something that traditional indicators aren't necessarily going to be able to capture. And indeed, we saw that. The sentiment declines. My predecessor, Richard Curtin, prior to the Great Recession, was one of the first to forecast a recession to come based on the data that was coming in from consumers. It's not necessarily that the consumers, realized there was going to be a housing market collapse or a financial market crisis. But sort of the wisdom of the crowd from the individuals in all of their individual contexts aggregated together gives us something that turns out to be quite meaningful.
Dr. Hsu, before we go, have you noticed any relationship between the administration in power and consumer sentiment? In other words, is it partisan? Do consumers feel better or worse under a certain leadership?
What we've seen over the last few decades, starting with the Reagan administration, is that if you belong to the same party as the party in the White House, you tend to have more favorable levels of sentiment than if your party isn't in the White House. And independents are always right in the middle. So when the White House changes hands from Republicans to Democrats or vice versa, you do see a rotation of Democrats and Republicans right around the independents. But typically, those two parties pretty much perfectly offset each other. And independents are right at the national average. And that is the case even during transition periods between an election and an inauguration. And in between those White House transitions, it's generally the case, and now is no different, that the three political groups, Democrats, Republicans, Independents, all tend to move together. And the decline that we saw in sentiment over 2025, the decline in expectations specifically, forward-looking expectations, it's declined for all three political groups this year. So it's pretty clear that people are responding to the same types of information, even if as a group there are some partisan patterns. And again, as I mentioned before, partisan differences in sentiment do translate to partisan differences in behavior as well. So what we are capturing is a reflection of how people really think and as well as how they behave.
Very interesting. All right. Well, thank you for your work. It's very important work. So I encourage everyone to check it out and participate in the next survey. Where can we follow your work and learn more from you and the University of Michigan in the meantime, Dr. Hsu?
We put out data just about every 2 weeks at 10 a.m. Our website is www.sca.isr.umich.edu. I'm sure David will post that somewhere for you, but that's where you can find our data right at 10 a.m., as well as links to our reports, historical data, and more detailed data as well.
Thank you. We'll put the links down below, so make sure to check them out. Appreciate it, Dr. Hsu. Speaking out soon. Take care.
Thank you. My pleasure.
Thank you for watching. Don't forget to like and subscribe.